sheet, and I'm only seeing about
I'm
40
recording.
something percent of breakouts working right now. So
Yeah. Hi guys. All right, we have Justin from the next big trade, and like in Kevin there, we've done like our NSBC trading system, but essentially it's Stein Weinstein's stage analysis, but like we added the weight of evidence behind it. So, but Justin, he's like the anchor of anything that's stage analysis out there, man. If he's been doing that like forever, so if ever like I have questions, I always reach out to Justin. And if I could jump right into it, Justin, like there's stage two breakouts are happening, but then I want to know, or if you could share your tools that takes you make a step back and say maybe that stage two has less chances of working out, and you could maybe share your screen or show us like if I don't know like some of the stuff you're looking at that gives you clues that I'm not going to play this
actually,
stage two.
if you guys pull up my website and go to my quotes section, and then Stan Weinstein has a great quote about if the overall trend of the market is not going with you. So yeah, if you go to the quotes section, I think it should be towards the top.
Yeah.
Um,
All right, there you go.
yeah, so you scroll down a little bit. Yeah, here you go. What's the trend of the market? If it's negative, you want to do very little, if any, buying, even if you see some stocks breaking out. Your probabilities of success are quite low when the market trend is going against you. So the overall trend of the market heavily influences individual stocks. And if you look at so the indexes right now, the S&P 500, the Dow are kind of masking what's really going on underneath the surface. Where if you look at the Russell 2000, that's a better example. Like that index has been going sideways since February, and that's been heavily influencing individual stocks. Where you've seen some stocks try to break out over the last 4 or 5 months, but a lot of them have come back in and not really followed through because the overall market, I think, is influencing individual stocks and just not letting anything really follow through and break out and go on a multi-week run. So like the current market that we're in is a lot different from 2020, where in 2020 you saw stocks run for multiple weeks at a time. We just haven't really seen that since February this year in this market.
Yeah. So here, this is the Russell. So if I look at this at a glance, it's definitely not in the stage two anymore. It's hold on, I could put it on, let's put it, I'll put my, let's say, put my Stan Weinstein setup. So it's underperforming the SPX on the Mansfield,
Mm-hmm.
and it's on the 30 week. I know you're using the EMA there, but look at that. That's the 30 week. So this is a solid close below that 30-week moving average.
Right.
Is it worth just explaining for some people what the four stages are? So a stage one is the basing process where you get a sideways movement of a stock price kind of fluctuating either side of the 30-week moving average. When we're talking about stage two and a stage two breakout, that's where the price bounces above the 30-week moving average, but it needs to do that on some kind of supporting volume. But you can see very often when you're coming out of a stage one and into a stage two, there are quite a lot of false alarms along the way. And it's not until you get to a particular point through the stage one basing process where you get the real stage two breakout. So there needs to be a way of identifying when that genuine stage two breakout occurs and leads you into that process that Patrick's just labeled on there, which is the stage two sort of bit that you really want to be involved in. And that, for me, that often involves breaking out through a horizontal or near horizontal, at least, resistance line. And it's also, as I say, confirmed with a significant increase in volume. I think Stan Weinstein says that the volume needs to be roughly double what it was in the previous 4 weeks, if my memory serves me. Although I'm still reading my way through the Stan Weinstein book, so you guys are more up on that than me.
No, that was pretty good. I mean, yeah, you want to see 2 times average weekly volume on the breakout week, or he says a cluster of volume, like on the breakout week and after the breakout week, a cluster of high volume is also a good sign too. And actually, some of the best breakouts typically have multiple weeks of high volume after the breakout week, which shows that institutions are just piling into the stock and pushing it higher. and they don't care about like getting another dip to buy into. They just want to get into the stock and get positioned. So they're all this volume's coming in and pushing the stock higher. That's typically the best situation you can have.
So, so a stage two is, well, as I mentioned before, there are 4 stages, and then after a stage two, you get this kind of leveling off period, which you can see in the Russell here. It's leveled off, and the question is, are we going to get a continuation stage two, or are we in a stage three topping? I mean, it is a stage three process at the moment. We're below the 30-week moving average, and they very often lead into a sort of a stage four decline. So, this sort of period of indecisiveness is tricky. I mean, it can bounce, and depending on the TA pattern that's forming, whether it's some kind of pennant or wedge or bullish wedge, it is possible sometimes to move below the 30-week moving average and then break out and continue onwards. So it's a always a difficult time. I find it hard when you get these sort of the end of the initial sort of first stage two burst, and then you're waiting to see what's coming next. Yeah.
Well, that's a great question. How are you handling this? Like, how are you seeing this?
Well, when I was less experienced, I would trade with full like position exposure during periods like this and just chop myself up because I would be trying to still catch breakouts a lot, and if they'd come back in and fall back below my stop, I'd get stop out and I'd lose some money, and then I'd keep doing it over and over. And then like you can really hurt yourself if you keep doing this over and over during these periods, and just your account just gets beat up like a death by a thousand cuts type of thing. Now that I have more experience, what I typically do is I just don't trade as much. I trade smaller size, take breaks, because these periods in the market can last quite a long time. So you really don't want to expose yourself to this kind of stuff for a long period of time, and really like it hurts your account and it hurts your confidence. So you really want to understand that this is a difficult trading like time in the markets, and you just need to, we're going to get through this eventually, and there's going to be a better market to trade. But right now the market's just in a choppy sideways kind of a pattern, and there's just not much going on. I mean, there are some stocks here and there that are kind of working, but what you have to do is kind of take profits faster and not look for like the long trending trades, because they're just so few right now. So it's, again, like these things, these periods happen in the market. You just have to understand that, and that it's not going to be like this forever, but it could last for multiple months longer still.
Do you ever envision, like, okay, so let's say you're looking at that let's say I would ask you the probabilities of you thinking this will resolve upwards or downwards. I know nothing has happened here, but you think this has a higher chance of eventually resolving upwards, or this is like like we're going back down? I don't know, man.
Well, that's like the weight of the evidence. You just constantly, I think what I do is on a weekly basis, I look at the weight of the evidence. So, and I try to just, I mean, when we're in a period like this, you really should be preparing your mind to the market could go either way here, right? So if you're completely 100% bearish here and the market breaks higher, you're not in the right frame of mind to take advantage of the breakout. And if you're 100% bullish here and it breaks down, you're not in the right frame of mind to protect yourself and get out and maybe go short or play defense. So you need to I think the right frame of mind here is just to be patient and wait and see what happens and trade less, maybe trade quicker on, if you buy a breakout, just take profits faster and get back into cash and just wait for better setups. But I think the market's going to show its hand eventually. Like you're either going to start seeing more stocks breaking out, or you're going to see some more stocks start rolling over, and then that'll tell you whether the market's going to go higher or lower.
Like this zone here, this was pretty much like the chop, right, that we could be heading into, and it could resolve maybe with a like exhaustion move downwards, like this is pure chop right here. Even you had until you went over these previous highs, even this stage 2 here was kind of super shallow.
Right. But this is the Russell, I guess. So not the indexes don't always show you exactly what's going on like across like because there were some good periods of growth stocks in there. There were some good periods where like gold or like silver or crypto had good moves. So you have to know like what the index is showing you and know that like the Russell's not going to show you the entire picture, which is why you look at other things too. And sometimes like for example with crypto in like February of this year, that was a great trade to have while the rest of the market wasn't doing very well. So like and gold does that sometimes too, where or other commodities where like they're in a good spot to trade while other things aren't working. So I think like you can't look at just one index and say like that's what's going on with the market, but yeah, like the Russell here is a good depiction of the overall market where not much really is working right now.
I think
I,
that's
I had this there. I know I don't remember if it's you used to use this, but or Stan used breadth. So like this is the percentage of stocks in the Russell that are above their 200-day moving average. This is the percent. No,
Mhm.
this one is the 200, and this is the 50. And I forget like it's when they're hot, like when there's no more stocks, that are able, like when they're all above their 50 and their 200-day, that means like you're overheating because what else could go higher, right?
Exactly, yeah, and vice versa too. Like when it bottoms out, sometimes that's like where the market's going to finally,
Here.
yeah. So the question is though, like when, like what you've seen here recently is a deterioration. The number of stocks above these moving averages keeps going down and has been trending lower, which is why the index has been having so much trouble moving higher because less and less stocks are participating right now.
Yeah,
So
and
the
you have to zoom out as well because just because the percentage of stocks below their 50 and their 200 is very low, for example, it can stay very low for an extended period of time during a significant market sell-off. So you kind of have to view it in a historical context as well. Just because an indicator is high or low doesn't necessarily mean that it's going to reverse instantly. It can gain a lot more or lose a lot more before it actually turns around. So
Wow.
it's really good to put things in good sort of historical context as well.
Look at this one, percentage above their 200-day moving average. That's like overheating though. This is a big
Yeah, like the rally last year, it's almost like it went to full participation earlier this
yeah.
year, and then it's just been slowly whittling away as the market's gone sideways for a lot of this year. So the question is, yeah, like basically the question is which way are we going to break out? We're just waiting for the market to show us what it's going to do. Um, and even like gold's in the same position right now. Gold's been going sideways for multiple months now, so we're kind of waiting for gold to tell us what it's going to do.
The US dollars at a critical point as well, around just testing the 93 level, which is a pretty important
Do,
level for determining where a lot of things are going, I think.
do you look at the US dollar, Justin? I don't remember seeing you talk about this much.
I don't really talk about like currencies are the one thing that I've never really understood why they move the way they do and how it affects certain things. It seems to be not consistent, where you'll see the dollar rally and it won't impact commodities or stocks, and then sometimes you'll see the dollar rally explosively when everything's going down. So it seems to be something that doesn't really, I don't know, it doesn't seem to really help my analysis, to be honest. But um, yeah, I
Probably,
guess.
I think that's partly because the US dollar is part of a jigsaw puzzle, and I think the other major part is interest rates, and in particular real rates. And at times, I think the real rates can be exerting more of a force on commodities than the dollar does. But it's a very complex equation that fluctuates over time. So I think you're right there. It can be very hard to weigh up whether the dollar rising is going to be anti-gold or pro-gold, because there are times when it doesn't make too much difference. But I think a falling dollar is generally a wind in the sails for gold and silver. But just because the dollar's rising doesn't mean gold and silver can't rise as well.
Mm-hmm.
I have another question, Justin. Do you, other than using the moving averages and horizontal breakout lines, Do you dabble? You told me last time, right, about the classical chart patterns, right? You're not.
I don't really like classical chart patterns. I think that they fail just as much as they work. I think in a lot of cases. I mean, sometimes I'll see them and and when they do work, it's like, oh, that makes sense because that falling wedge broke out, or that kind of cut pattern kind of broke out or something. But I don't know. The other thing too is I don't know what time frame to use those on, because like if I'm just trying to catch a trending move and a pattern, it breaks out from a pattern like that, like how long does that pattern tell me to hold it? I'm not really sure. So I really like moving averages and horizontal resistance, like just like Stan put in his book. I think it makes things really simple. And like again, like if I see those patterns in the chart, sometimes they make things. Sometimes it make a little bit more sense because that pattern will resolve itself, but I don't. It's not really my main and way the way I analyze things. It's kind of just a side thing that I might look at, I guess.
Yeah, it's well, like everything's derived from the price. So usually when, let's say, Kevin spots a bullish chart pattern, well, there's a high probability that it's in a stage two, But
Mm-hmm.
sometimes a chart pattern is going to make you catch something that looks super ugly on the weekly chart. But when you take a real big step back, it's just that 50% correction was just a back test of some other line somewhere else. But you're right. It's still the way I see it is if you have a stage two breakout, which also is a classical chart pattern breakout, then man, just everything goes together, right? Like gold is perfect. I'm pretty sure we had synergy in gold in June of 20, like right here, there. Where's the stage
Right.
two
Yeah.
breakout for you? Somewhere
And
here?
that looks like a cup and handle too. So I think that the chartist could, or the chart pattern person would kind of see that too. And, you know, so I think, yeah, like I think what you said is correct. Like, a lot of times these chart patterns find themselves within the classical stage two breakout pattern as well. So they just kind of happen to go hand in hand.
Well, I think for example, a falling wedge is typically a bullish pattern. It resolves to the upside more often than not, but there are times when it resolves to the downside. But the thing is, not all falling wedges are destined to succeed. And one of the things that determines whether they succeed or not is how far along that stage one basing pattern it is. If it's on the
Mhm.
left-hand side of the arc that Patrick's just drawn there, then it's a greater risk of failure because it's still in a gradually downtrending part of the stage one basing process, if you like. It's still effectively in the stage four decline, I suppose. As you move to the right-hand side of that arc and the arc starts to guide price upwards, then it follows, logically that falling wedges are more likely to break upwards because the overall trend is upwards. And as far in Stan's methodology, you're starting to transition from a stage one to a stage two. So in a stage two, then of course you'd expect all the falling wedges to be breaking to the upside because that's what happens in a stage two uptrend. So it's not all. What I'm trying to say there is not all chart patterns are going to be the same. Just it depends where they're occurring in the cycle, and this is all to do with it's all cycle theory as well. It all ties together. Cycle theory, arcs, stage analysis. What's that other thing? Wyckoff theory, Wyckoff distribution, and accumulation. They're just different ways of kind of describing the same sort of cyclical nature, I think, of the markets.
Yeah, and if you're looking for the bigger base is part of what Stan Weinstein talked about too, where a breakout from a large basing formation is actually a pattern you want to look for, which goes right with the arc and how the arc like finishes off the base there and it breaks out into stage two. So I think that's an example of where they're both lining up, like just what you're talking about there.
Yeah, yeah. It's
And
it's almost like using two different languages to describe the same thing. Just because you got someone who's French and someone who's Spanish talking about, I don't know, their favorite beer, they're both saying the same thing. It's just in a different language. So it's the same thing here, I think.
well, that's why there's different type of TA, and everybody should find the one that fits their personality, because that's the only way when the emotions get high that you'll be able to respect your own framework. Because all these observations is he's just analyzing bullish clues, and he wrote them down. Okay, when this happens, the price has a tendency to go up. Higher lows, 50% off a base, right? Stan, he said never buy. He says most of the stocks he buy, they move practically 50 to 100% right off the lows, right? And that's just carving out higher lows, which is a bullish. Man, who needs to read the book? Everything's here, Kev. Why did you buy the book, Kevin?
Yeah, it's good picking out all of the quotes there, because it's covering all of the key sort of takeaway points that you need to remember. It's good.
Did you
It's
write all of these
amazing.
out, Justin?
Yeah, well, I mean, I still go back in there and I still find stuff, and I've done this I don't know how many times. So it's unbelievable to me how many times I've read Stan Weinstein's book, and I still find information that I want to highlight in a quote, or I want to like really kind of focus on. I mean, there's just so many nuggets in there. It's great, and there's other books like that, like Reminiscences, and there's like multiple books related to Jesse Livermore that are great, and Mark Minervini's books are awesome. The Perfect Speculator, I think, is a good complement to Stan Weinstein's book. So I think I've got a couple quotes from that book at the bottom here. So yeah, there's definitely somebody that's looking to level up their trading. Like, find these like great books and read them multiple times, and really digest the information. I think that can really help somebody that's just learning this stuff.
Yeah.
I saw you posted this week there on cryptos. Did something change recently? Like I thought that you
Yeah, actually, yeah, it was a good example. Like right after we talked about how Bitcoin was underneath that resistance and underneath the moving average, and then all of a sudden it just like broke back out. And Bitcoin is still underneath that resistance, but some of these other cryptos, like I was looking at, there's some new ones like Solana and like I don't know, is it like Terra or something like that? There's some new ones that actually don't even have any resistance anymore. This one
wow.
definitely, this one exploded on volume. Ethereum and Cardano are in
I
better
was going to
position
say,
than Bitcoin as well.
I'm glad you mentioned Cardano, because that's one I've been looking at. It's
Okay.
yeah.
This one, Justin. Okay, the volume. How do you deal with that? Because it's crescendoing up. So the breakout candle it's probably this one, right? The last week. This is just this week. It's continuing, right? But if I would have been nitpicky, I would have said, like, how do you? This is not twice the average of the previous 4 weeks. It's maybe 30, 40%. Or you're telling me, Patrick, you're complicated things too much.
Well, it never went below the 30-week, did it? I don't think there.
No, it didn't. Yeah, it was just showing a lot of relative strength. It kind of showed you that these other cryptos were probably going to be leading next because they didn't break down like Bitcoin did. Like the volume in these is, first of all, I don't really know. I guess the volume is representing the number of cryptos exchanged or something. I'm not really sure, but I have noticed the volume on most of these moves hasn't been as high as what happened earlier this year. So that gives me a little bit of less confidence that these are going to be like the same type of explosive moves that happened like earlier in the year. But I'm also kind of curious as to how they actually do the volume there, I guess. But so and this actually has some of the most volume. Like some of the other ones barely have any volume on this recent move. So I think that might show you that, again, like this market right now, it's kind of like a boat out at sea, like not moving anywhere. I think like I saw that quote from like Jim Ropel. He's a hedge fund guy in another interview, so I want to credit him for that. But I think that's a good analogy where like the market's just sitting there out in the ocean, and we're just waiting for like a gust of wind to blow it in either direction right now, whether it's going to be to the upside or back to the downside. I don't really know yet. But yeah, some of these, getting back to these cryptos, there has been some good moves in some of these cryptocurrencies recently.
And Ethereum.
Well, a lot of them have gone up something like 100% in the last couple of weeks, haven't they? I think Bitcoin's gone up probably more like 50%, is it, from 30,000 to 45-ish. So I think Bitcoin's gone up about 50%, but a lot of the altcoins have gone up closer to 100%.
This I would go. My confidence level is super high here because look, it's clearly double the average of the previous 4 weeks. It has a huge base, so and it's kind of yeah.
See, that's exactly right. Like that's where like you take all the factors of stage analysis together. So yeah, you got a bigger base back there. You had bigger volume, and it's like that's like the original stage one base, right? Now you're trying to do a stage two continuation breakout off of a huge move that just was in the past. So I think that's correct. The probabilities right now are not as good of a huge move because we just came off of one and the base is smaller. It doesn't mean it can happen, but it's always a probabilities game. You're always trying to figure out like what's the probabilities were just better back then based on that setup than they are now.
So I think tell me what you think about this, Justin. I think Bitcoin and Ethereum are the two sort of market leaders in terms of dominance of the market in overall sort of volume traded. If you compare Bitcoin and Ethereum to each other and how they're performing, Ethereum's outperforming Bitcoin quite significantly and has been for some time now. So when looking at other cryptocurrencies and whether it's worth investing in them, the Mansfield Relative Strength Index at the bottom there, if you compare Ethereum to whatever cryptocurrency you happen to be looking at, then that makes a lot of sense because why compare your potential purchase to Bitcoin if Ethereum is outperforming Bitcoin? So setting that Mansfield Relative Strength Indicator to compare your there you go. You can see it there. You can see Ethereum is outperforming Bitcoin. So if you compare, I don't know, Ripple or whatever it happens to be, Cardano, whatever, to Ethereum, as long as that is outperforming Ethereum, then that's a good position to be in. So there you go. Ripple's outperforming Bitcoin, but then double check, Patrick, see if it's outperforming Ethereum because that's what you want to be. It's not. So not yet. So you stay in Ethereum until that breaks out against Ethereum, and then makes more sense to jump in at that point once there's a trend initiating where Ripple's outperforming. So that's one little tip that I would give. I think with the cryptocurrencies, just move your investments around and make sure you're always in the market leaders. Otherwise, you're kind of not maximizing your potential gains.
Is that when you compare the cryptos, are you comparing them to what are you comparing them to if you're using the Mansfield SPX?
You asking me,
I just have
Patrick?
SPX by default on my chart, but I think it would make sense to use Bitcoin there instead of SPX. Because like Kevin said, it's really like you're comparing it against.
I think.
Well, okay, there's different ways to look at it. If you want to compare it against a different market you might trade, then it makes sense to compare it against SPX. If you're going to compare it against other cryptos that you might trade, then compare it against Bitcoin or Ethereum, I think, are the two main ones.
Exactly. I mean, I think it depends on your mindset. If you're an investor who is investing across multiple markets, then compare your markets against each other because you want to weight your investments to the market that's performing best. I would invest in anything really. It doesn't matter whether it's commodities or whether it's something in the general stock market or whether it's cryptocurrencies. But I always want to have my funds in whatever's performing best. So if cryptocurrencies as a whole are not outperforming the SPX, then why bother being in cryptocurrencies? You need to be in stocks in the SPX that are performing well. It's all a question of how you want to balance your portfolio and how much care you want to take of your portfolio. If you just want to stick your money in there and forget about it, then don't be too surprised if you end up not making very much money because you need to actively manage it. It's just a question of doing some due diligence, I think. But given that the crypto market is moving now and has moved 50 to 100% in the last couple of weeks, then it's a good place to be invested right now. Just choose the coins that are outperforming Ethereum, and certainly choose the ones that are outperforming Bitcoin.
I'm wondering, Justin, if do you have live sell stops like that are live? Because look at this crypto on Kraken exchange, Ethereum, this wick was nasty. Or do you wait at the end of the week and then you decide what you're going to do?
I've used both methods myself. Right now I'm using more since I'm watching the market. Like, I mean, I'm not watching tick for tick, but I'm checking in on the market on a daily basis. So I feel like I can manage my portfolio without putting stops in. But I think for someone that's away from the computer more than that, I think putting stops in makes a lot of sense. And I think Stan Weinstein actually recommended that as well. So I think either approach probably works, but you have to make sure to follow your stops though if you're doing it manually yourself. So that's an important thing. You can't pull your stop out and just give it more time because your stops are what are allow you to like manage your losses, and then your gains need to be a factor of your losses to really make money in the market.
I think that's important as well, because if we sort of agree that the cryptocurrencies sometime in the next few weeks or months are going to reach their high for this cycle, it's important to remember that when they do hit that high point, a lot of them, when they begin to turn, will perhaps lose 20 or 30% in a day. And if you haven't got your stops in there and you happen to be busy working that day, and you suddenly switch your computer on at the end of the day and find it's fallen 30%, and it that's the start of the bear market, and you're not going to get a chance to get that 20 or 30% back. So it's important to either keep a close eye on it manually or set those stops, I would say.
Mm-hmm.
And I'm wondering also, like, when you see something go parabolic there, where it's like zeros that are getting added. So let's say you entered here and it goes up fine, but at the end, are you using like the 10-week moving average? Like, would you have sold? I know hindsight's 2020, but would you have sold on this? Let's say you would have gone here, and would you have sold on the close of this candle below the 10-week moving average? How's your motions?
Well, if you look at that move, I have a rule in my own trading system where if I see a high volume sell off like this, I can close everything out, because this tells me that something's probably wrong in the market now.
Yeah.
I mean, it doesn't always work. Like, nothing obviously works 100% with this stuff, but this is a good indication that the supply demand equation has changed now, and the market's going to correct more. So I allow myself to like just sell if I see something like this. But yeah, like if when a market goes parabolic, like for sure, I definitely want to sell into strength, and I always I don't ever sell anything like 100% at a time. Like I'll try to, if I'm selling into strength, I'm only going to be selling a piece of it and trying to still ride some of it, for more of the move if I can. So I think you don't have to, when you're selling, you don't have to, and when you're buying, you don't have to work all in or all out. You can do it bits at a time, and this will work to your favor when you're trying to catch longer term moves, because you're going to be still holding some if the move is still going on.
Yeah, that makes sense. But it's in line with human emotions, because everybody's like binary, like, oh man, it's like I'm in, I'm out, I can never go back. That's the toughest part about trading, is being like going with the flow, and not going extreme in each direction. It's like a recipe to get whipsawed.
Right. And I think, again, like, you never go all in or all out at one time. Like, take things, selling pieces, buying pieces, and I think that's the best way to manage, because you're never going to be perfect. People want to be perfect with their trades. I want to sell at the very top, get everything out, make the max profits. That's not realistic. Nobody ever does that consistently.
You can't do that, Justin. Come on.
And isn't that the beauty of the Stan Weinstein methodology, though, because it accepts that inability to catch the very top and catch the very bottom by using the processes he describes. You kind of sort of mentally prepare yourself for the fact that you're not going to get in at the very bottom and you're not going to sell at the very top, but you catch the bulk of that move. And I think looking back at most of these market moves and the percentage gains that you can build up over time, I think the vast majority of traders and investors would be really, really happy with those results.
Exactly.
And I think we talked about this last time too. These Bitcoin people, like, they were complaining about the recent pullback. I mean, if you were following Stan Weinstein, you had plenty of time to buy on this breakout and ride this move. it's only the people that got in late that, were really caught and whipsawed, and so it's so important to catch the early part of these moves if you want to really make the money off them, and not get in too late. You need to follow the rules. Stan Weinstein laid those rules out like explicitly in the book.
That's why we're sticking to that with our green report, Patrick, isn't it? We're not filling the list with a load of stocks that were halfway through their advances. That early entry is the point to recommend. The higher up the advance that you take your position, the riskier it is.
Oh, look, I'm scared. Honestly, here, I remember this in the cannabis sector. Like the people, like it was years before. Like I don't know, it's kind of tricky here. Honestly, even the cryptos, it looks like a continuation breakout, But honestly, we all know, and this everybody has to hear. 280, 250. That was the time, guys, for Ethereum. Right now, it's tough, man, because everybody's talking about it. It's on everybody's radar. And I just put this to show, look, guys, this is not lost profits. This is actually guaranteeing you or increasing your odds that you'll get this. So this 250% move off the bottom is not lost money. It's actually helping you solidify this move, right? And you
That's
see,
a really good way of thinking about it, Patrick. Actually, I like that.
yeah, it's like higher lows. You're creating momentum. You're creating trend. So this is the price to pay. And worst case, if this falls down, then no harm, no foul. Because a lot of these, sometimes they just need more time, right, to build. So there's nothing wrong for waiting for that. So you left 250.
If someone's looking at this and says, "Man, I wish I would have caught the move in Ethereum. I want to buy now. I missed this. I feel so bad that I missed this. I just want to jump in and get in." That can be a terrible mistake because you're getting in right after something moved and it might not move again for a while. Like what you need to understand is that this pattern is going to set up again and something else probably at some point in the future, and you should be able to catch that by recognizing that new pattern in that next thing and catching that move. So it's not about catching the previous move in something that just happened because you're jealous of it. It's about catching the next move in something that's setting up properly.
Yeah.
So it might be Ethereum again, it might not, but you just need to look at that pattern and find it again in something else, and then use that to trade the next thing properly. And we're going to see these patterns over and over time. So if you're in a period like now where things aren't working very well, you just need to be patient and understand that at some point in the future, this is going to work again, and there's going to be huge trades again to have. You just need to be patient and let them set up again, and don't cut yourself up too much in between when this happens again.
Yeah, I agree. Like when you're looking at cryptos, which are maybe doing a continuation move up, there's some sectors where they're just like this, where nobody wants them. There's a whole bunch of them. I'm starting to scan sectors that nobody's talking about, and you see stuff. Wow, look, this thing has been basing for, even here, like the rare earths. We kind of missed the initial breakout, right? It was just violent. It was beautiful, and we missed it though. But
it was exactly the same in the uranium sector last year. Nobody was interested. Nobody was talking about it. People could only remember Fukushima. They couldn't look at the chart and actually accept the fact that it had a massive breakout there. I mean, it's come down a huge amount when you zoom out and see where this index has come down from. Up at around 150 or something like that. We went down to, what was it, about 6 or 7 or something. We lost 95% in that period of time, and we've had a breakout there. What's happening now is a bit of a mess. looking at the chart, we're seeing a big pullback here, and there's no knowing just where that is going to bottom out. But the point is that we've had the uranium breakout, and medium to long term, this is looking like a really good potential place to put your investments, but certainly not at the moment. We've had a good move. The signal's now been given to step aside, and you have to let the dust settle and wait for the next set of bullish conditions to set up.
Exactly. And I mean, if you think about crypto, when it broke out in October or so of last year, like hardly anybody was talking about it. I remember a couple of traders on Twitter were pointing it out when it initially broke out. It wasn't anywhere close to like what it is now with all these people talking about it. I mean,
I was jumping up and down, shouting 10,000. It's broken out to 10,000. Get in, get in. But I don't know how many people did.
There was no laser eyes back then. None.
no,
Look
that
at
all
that. Look at the
came earlier
volume.
this year.
Look, guys, look at stage analysis. Look at the volume. If huge base above a 30-week moving average, insane volume. That's all she wrote, guys. But you don't need to FOMO because most of the time you get another shot at glory, like to get in, and then that's it. And that's what you come back at, Justin. I like that. Like, people should not FOMO in because sometimes it take 1, 2, 3 weeks before it really takes off, right? So even more sometimes. But this was the time. This was the time, guys. Huge base for a fast move. You can't have. It's hard to have a fast move after a small base unless it's like a parabolic melt up. Then how do you get out of it? Like, it's tricky, right?
Quickly.
Well, that's why we're going to use the 10-week moving average to get out, because the 30, if you wait for the close below the 30, could be too late.
Yeah, if we go parabolic in the next few weeks, the 30 will still be where it is now, pretty much. So yeah, if we suddenly go to 200,000 in the next 8 to 12 weeks, the 30 will still be close to where it is now. So yeah, start using the 10, or even something shorter than the 10 if it goes truly parabolic.
Yeah, the 10, and you use the EMA on the 10 also. Just I'm gonna add the EMA.
I just like the EMA better overall. I get so many questions about that. I do not think it matters. Like, I think either one is fine, but the EMA just moves a little bit faster.
Well, look at that, Kevin. Interesting, right? The EMA 30 is a little bit closer to the 10 regular, which makes sense. And it's faster to give you the breakout signal. That's why
it kind of gives you, like, around these like turning points, it kind of gives you, like, it'll turn faster, so it'll show you the trend a little bit quicker. But again, like in a choppy market, though, it's just going to go back up and down, up and down, up and down until it finally breaks out again.
Wow.
I think one critical thing for people to understand is, like, these big bull markets, they come from bear markets. So the big sideways bear market in Bitcoin produced the big bull market, and vice versa. A big uptrend, what happens after that is a bear market, whether it's a sideways bear market or whether it's a down bear market. So if you don't want to be caught at the end of a big uptrend buying a bunch of stuff, because the next likely place the market's going to go is either sideways or down, which is what the patterns in the stage analysis are. So it's so critical to buy at these early points, breaking out of a base into the uptrend.
Yeah. It's always like 138, like almost 1,000 days of consolidation, building up energy, and it's a quarter of that, and you ride up. It's never. I've never seen an uptrend as long as the base, or maybe there is, I guess, but usually it's the rides.
How about general equities that just go up and up and up? And
I know. When I was saying that, I said, yeah, of course, the U.S. equities, it's forever, but
you get
that's because the
sell-off, and then it just goes back again.
Well, the indexes boot out the stocks that aren't performing as much, so that's why they automatically, like, get rid of those and recycle and keep moving higher. But you still have big corrective moves in.
Yeah, you get the big corrections, but it's not really what you call a base so much. It's just sort of a sudden V-shaped drop that ends up higher than it started every time.
But you should, like, my mindset at the end of these big downtrends, like, you need to be looking for opportunities, because that's where, like, the opportunities are going to be. Because there'll be stocks or other sectors that'll be, like, showing a lot of relative strength when those bear markets happen. If you can get into those that are showing massive relative strength after those bear markets, that's where you make big gains. That's what happened in 2020.
So, guys, hoard your capital and just get ready. This is not financial advice, but you're right, Justin. You have to flip your mindset. Somebody's touting something. At least use Stan Weinstein. Go through the Stan Weinstein thing. Did I have a huge base? Do I have a horizontal breakout on volume? And then you have a fighting chance. But usually if somebody mentions it, unless it's you, like, let's say they're following you and you're mentioning it, we're probably still early, right? But if you're following somebody with laser eyes, it's probably late in the cycle.
Yeah, that's a good, yeah.
because
But I think, yeah, key, like you need to understand how the overall market impacts lots of assets. So like right now, the overall market's is not going anywhere. So that's why you're seeing a lot of just drifting sideways chop. Like you just have to understand this happens in the markets and just be patient. Enjoy the rest of your summer and just keep your eye looking for opportunities, but don't. The market's going to tell you when to pounce. Just let the market lead you into these trades.
man, that was awesome, Justin. I don't know if Kevin, you want to add something to close it up?
Just, I think keep learning, guys. I mean, this kind of methodology and having some kind of technique that you stick to and that makes sense and that kind of checks out when you go back in history and just back test all your methodology and make sure that, given the benefit of hindsight, that it works, and don't be kind of whipsawed around this just find a method. Stan Weinstein's got a great methodology there. If you stick to that and you use that as a basis, you can tweak it. I mean, myself and Patrick, we've refined it, we've added our own technical analysis techniques and just fine-tuned his work. But I think it's very, very hard to get in at the bottom and out at the top, and don't aspire to that, because it's a fool's game trying to do that. You just can't, don't kid yourself. You can't do it. You just can't do it. So yeah, it's what Justin was saying earlier on, absolutely valid. And yeah, good stuff, Justin. Thanks for joining us today.
Yeah, it was another great discussion. I really appreciate talking to you guys, and we should just keep doing it again in the future. So
yeah, definitely good stuff.
Yeah, everybody follow Justin to get those early breakout entries. He's doing all the hard work for you.
Yeah,
All right, guys.
the next big trade, isn't it? So yeah. Follow Justin.
Yep. Nextbigtrade.com and Nextbigtrade on Twitter. Thanks, guys.
Okay,
Bye.
cheers.